I'm 71, and I rolled my Roth IRA over to a money market with my financial guy. I did not roll it over at a bank, and I've been wondering if I did the wrong thing.
No, you didn't do the wrong thing, Carol. I mean, what you did was you got it out from under it being exposed to a market downturn, and you did accomplish that. And I think that's good, and I'm glad you did it. Now, it's not insured. It's not going to be FDIC insured if the crisis is a lot more than a correction, and we had some kind of bank failures around the world and around the country. Then, you're going to stand chance of loss because, you're not going to have any FDIC insurance. But if we have that scenario, global financial crisis where we see bank failures, FDIC is not going to pay out anyway. So the key is that you're protecting principal for the downside. If the financial crisis gets to the point, or the downturn in the market gets to what happened in 2008, do you remember, Carol, in 2008, when we had the collapse there, that the government quickly mandated insurance or money market accounts to be $250,000? I don't know if you remember that. Well, the reason that happened was because those money market accounts broke the buck, it's called. In other words, when you put money in a money market account, it's a dollar is worth a dollar. It is, for every dollar you put in, it's worth a dollar. That's the share price, so to speak. It's a dollar. And if you have $10,000 in there, you have 10,000 shares at a dollar. Well, what happened was, in that crisis, it broke a buck because some of these mutual fund companies made some bad bets. And we saw that dollar go to, I don't remember what it was, but I'm thinking it was like 92 cents or something. And it sent panic through the financial sector. And a lot of the average person doesn't remember that, but it did. And the government reacted very quickly to make sure they shored that up, and it didn't happen. I suspect they would react the same way again this time, but will they be able to do anything about it? That will remain to be seen. But I don't think you did the wrong thing. I think you did the right thing by preserving that principle and getting out of the market. I would stick to it at this point. If you're really uncomfortable, then you can roll it over into an IRA at the bank and put it in a FDIC-insured money market account.